Good afternoon, good morning, good evening, depending on where you are as you're watching this today. I had to just take a flip over to check the news again to see if President Trump had made any more market moving headlines here in the last 20 minutes or so, or what else has changed. Actually, we're watching for the RVO announcements on the biofuel from EPA, but I'll talk more about that. My fear is that they'll come out during this presentation and they'll miss it. But overall, let's go ahead and get started. We did have a USDA WASDE crop report today. A few changes on there, which we'll highlight, and we'll talk about some of the other factors. I appreciate all of you being with us today, and we have a good group again with us today. The June report isn't known for being a really dynamic report where we get big market moving changes in the supply and demand numbers, either globally or domestically, but there are some things to talk about. And so we'll try to cover those, including the weather pattern that we have set up for the Midwest as we go forward. But first, let's talk about the money flow that impacts how the market manages supply and demand, since price is a function of supply and demand, but is modified by that flow of money. So as we look, first of all, at the consumer price index, and this was updated yesterday on June 11th, and we see basically that both the core and headline CPI pretty stable right now. Still not at that 2% level. They haven't been at that 2% mandated level now for more than 3 years. Goodness, I think it's long. It's actually 4 years. It's over 4 years that it's been since, I believe, March of 2021, since they've been at that level. We're looking at the headline number at 2.4%, ticking up slightly, but not as much as what was anticipated due to the tariffs. The market had anticipated the tariffs to start having more of an impact on inflation by now. And while we see some early indications and signs of it, it's simply not showing up to great extent. And yeah, it probably still will. Probably not as much as what was feared, but probably more than what we've seen to this point, somewhere in between. We'll talk a little bit more about that, about the tariffs going forward. The core inflation level that excludes food and energy, because we know energy prices have really been on the decline, weighing on energy. So looking at the core, just what's happening behind food and energy prices, pretty stable at 2.8%, and that too being well above the 2% level. And that's largely due to the services industry, where we see the greatest stickiness in our inflation. And I'll show you more on that in a little bit. Our producer price index, though, continuing to trend higher. That's something we need to keep an eye on. And that is something that's really been happening since 2023, when we set our lows in there on our headline number. And that's been one of the reasons that I've been calling for a resurgence of inflation really for the last 6 to 8 months, if not longer. And that was long before Trump had been elected and talked about tariffs at all. And it's for other reasons, some of which we'll get into today. You know, that's at the wholesale level, which tends to make itself to the retail level. Here we see that the service sector continues to trade above 3% overall for inflation. Consumers, back in April, when President Trump put on his reciprocal tariffs, the headlines were about how it's going to be a disaster for the economy. We're destined for a recession with runaway inflation, and consumer fear was high. Consumer confidence plummeted, and the consumer surveys showed that they expected inflation to go up over 7% over the next 1 year, and up over 4%, closer to 4.5% as we get into the 5-year average overall. So that's a big surge in inflation, probably more than what is justified, but that depends on what you believe is going to be the end outcome of the tariffs, versus, them just escalating up and getting in a tariff war, versus causing countries to come to the table and negotiate their tariffs down, by which time President Trump would lower them. So it depends on how you feel about that, where you think that inflation is going to be overall. If we look at this chart, which has been a popular one, I get a lot of feedback on this one. Again, if you've been a regular, you've seen it. Comparing the current inflation cycle that we are on, as indicated right here, versus what we had in the late 60s through the early 80s. And again, I've been calling for a resurgence of inflation for some time. That is the typical pattern. Once you've pushed inflation above the 6% level, you almost always get a rebound cycle of inflation. Maybe not to the level up approaching 15% that we saw in 1980, but certainly a resurgence of inflation. But this time, much of it tied to our national debt and the fact that we have a fiscal spending problem, runaway budget deficits creating problems. But we're keeping an eye on it. You see here that we have curled back up. What will we do now going forward? We'll continue to monitor that. Now let's tie that to the commodities. And once again, the dark blue line being our StoneX commodity tracker, which is this basket of 27 different commodities, including the grain and oil seeds, including livestock, which we call the protein sector, including the energies, including precious metals, including industrial metals, including the softs like coffee and cocoa. All of them. And this is showing a 10-year correlation here of 0.86. And in statistics, we say a correlation above 0.7 is considered statistically significant. And we're at 0.86, so pretty strong over that 10-year period of time. Also wanted to highlight, remember I told you about the consumer reacting to all the headlines about runaway inflation? But what's the market trading here? Expectations that inflation over the last couple of months been trading declining inflation expectations, a little bit of a bump there before coming back down, but overall trending lower. Now, probably much of that was due to fear of a recession, to be honest with you. But we see this even more so on the 2-year trending lower. So that's quite contrary to where consumer inflation expectations currently are. And of course, I've said, as I just said a little bit ago, I do expect a rebound in inflation. I expected it even before these tariffs come along. But right now, that 2-year break-even inflation rate, the market expecting here over in recent weeks that we'll actually see a decline in inflation over the next 2 years. So, but I guess I, in fairness, should cover here the correlation 0.84, but basically showing, once again, that when the market thinks that we're heading into a time of inflation, they want to own the commodities in their portfolio to hedge their portfolio against the eroding value that inflation does to it, and eroding the value of their portfolio. And because they assume that commodities are going to go up in price when you have an inflationary economy. And contrary to that, when the Fed's coming in here to lower interest rates, they assume that's going to lower inflation by raising interest rates. They assume that's going to send us into a recession where demand for commodities declines. And so they reverse from being long commodities to short commodities. And that's one of the reasons you get this correlation. Now, as we look at actual correlation with inflation, the correlation right now is at 0.79, and that's declining largely because of the separation we've been getting over the last couple of years. And why is that? Well, if we look at the correlation between the grain and oil seeds and the CPI, it's a strong, I think, 0.86 or 0.87, something like that. When we look at energy, I think it's a 0.88, very strong correlation. But let's look at some of the other commodities here. Precious metals have been on fire, obviously, with the records set by gold prices this year. Livestock, the protein sector, on fire. Cash cattle trading in the $235 to $240 range this week. We're seeing choice cutouts of meat trading up there 300 above $365 per hundredweight, just some very high.